What if I told you that the biggest tax overhaul since 2017 just became law, and hardly anyone is talking about what's really inside of it? On July 4th, while you were grilling burgers and watching fireworks, President Trump signed a bill that quietly rewrote your tax future. I'm talking new deductions for tips, zero tax on overtime, expanded credits, and a permanent shift in how small business owners plan, spend, and grow. But here's the kicker. Buried in this monster bill are phase-out traps and massive tax cutoffs that you need to know before your next financial move. Today, we're going to unpack everything, line by line, deduction by deduction. We're not talking politics. We're talking about taxes and your profit margin. So let's dive into it. The bill that passed was H.R.1, the One Big Beautiful Bill Act. And this was cleared by Senate. So remember, the House kind of wrote their version of it. Then it went to the Senate. The Senate changed some things and they passed it on July 1st. And then it went back to the House, and the House concurred on that bill on July 3rd. President Trump signed it into law on July 4th. And so we've been holding back on talking a lot about what has been being thrown back and forth because we wanted to wait until things were finalized. Once things are finalized, now we can actually begin to act. We can say, okay, we know what the law is now. How do we plan around it? And now that's finalized, now's the time of that. And the first things first is a lot of the Tax Cuts and Jobs Act items from Trump's first presidency, a lot of those items from that tax bill have been extended or made permanent. So that's some good things to talk about there. And today we're going to be talking about tax specific items. So this was a massive bill. There's a lot of different things covered. There's spending involved, there's cuts involved, and there's tax cuts involved. There's tax items involved. Today we're going to be talking about the tax specifics. We're not going to get into the politics of all these other different items. We're talking specifically about what the tax pieces of this bill were. Now, I'm going to be doing a high overview, talking about some of the major items as I'm still uncovering a lot of this tax bill. So I'm going to talk about some of the major items, the major things that you need to be thinking about that are part of this tax bill, but follow for more items. Follow me, like, subscribe, whatever it is, follow me as we continue to deep dive and dig apart this tax bill. We're going to put in more videos, more content, more items up to make sure that you know everything that you need to know about this tax bill. Now, today I'm going to break out the different pieces of the tax items of it into two pieces, a personal side and then the business side. So there's some personal items and then there's some business related items. So let's start with personal. The first thing I want to talk about is a permanent extension of the Tax Cuts and Jobs Act individual tax rates and brackets. So these were brackets that were part of the Tax Cuts and Jobs Act from Trump's first presidency. These were set to expire at the end of 2025. That is not happening. They've been permanently extended. So the big news is that the 12% tax bracket is not going to spring back to the 15% tax bracket, but rather it's going to remain the same. So that's good news. The second piece is the standard deduction. You'll remember in the Tax Cuts and Jobs Act, the standard deduction increased significantly, but part of that is personal exemptions were taken away. With this new tax bill, the big beautiful bill, the standard deduction from that Tax Cuts and Jobs Act has been made permanent as well as with adjustments for inflation. So these were set to expire, go back to the old rates, but instead it's going to remain permanent and it's going to adjust for inflation moving forward. So 2025, the standard deduction for married is going to be $31,500 and $15,750 if you're single. Now, with this, they also had the personal exemption has been completely eliminated permanently as well, which we would expect. That's part of the benefit of this increased standard deduction. So standard deduction will be permanently in place, as well as the tax rates. Those are good things. The next piece is the child tax credit. So starting in tax year 2026, the child tax credit is going to increase to $2,200 from $2,000, and that's per child. So child tax credit got a slight increase. House and Senate kind of have different opinions on this, but the end result, $2,200, and that will increase for inflation moving forward as well. But that's $2,200 per child. That's a child tax credit increase. One of the big things that Trump ran on in his presidency is relief for Social Security. And so there is some senior tax relief that has been put into place. Now, this is for tax years, specifically for tax years 2025 through 2028. So just for 4 years. Now, this might extend it, they might enhance this, whatever it might be, but this is a temporary relief for the next 4 years. And it's temporary. It's going to be a temporary $6,000 bonus deduction that's available for individuals aged 65 and older with incomes up to $75,000 if you're single or $150,000 if you're married. Once you hit that $150,000 if you're married, that deduction is going to start to phase out. So again, a temporary $6,000 bonus deduction available for individuals age 65 and older, and it will start to phase out once you hit income of $75,000 if you're single, or $150,000 if you're married. Now let's talk about the state and local tax, the SALT deduction. And if you've been following this bill at all, you know that this has been highly contested, especially from those congressmen and those senators that are from high income states. They want this number really high. For those that are in low income states, they don't really care about this number. So this is a highly contested area. And so what they did is they raised the SALT deduction cap for tax years 2025 through 2029. So for the next 5 years, the SALT deduction cap is raised from $10,000 to $40,000 for taxpayers earning less than $500,000. There's going to be some phase out. There's going to be some reduction of this once you get over that $500,000. After 2029, the cap reverts back to the $10,000. So you'll know that after Tax Cuts and Jobs Act, SALT tax, state and local income taxes on an itemized deduction standpoint were capped at $10,000. That $10,000 cap has moved to $40,000 for the next 5 years. So for those in high income states, this is a big win for you. The next piece I want to talk about is no tax on tips and overtime pay. This was obviously part of a campaign promise. A lot of the people, both Kamala Harris and Trump are running on this, but this is a change. There's going to be no tax on tips and overtime pay, and we're going to talk about the details on that. Now, this is for tax years 2025 through 2028. So that's for the next 4 years. Let's talk about tips first. It's going to allow eligible workers, think servers, bartenders, to deduct up to $25,000 of reported cash tips from their federal taxable income. Now, you might be a business owner thinking, okay, I see what you're doing there. Let's start moving all of our income to tips. What they say is it's got to be eligible workers. So think of an industry that is typical for tips. So if you're if you're an accounting firm, if you're a financial advisor, you don't really get tips. If you all of a sudden are showing a bunch of tip income, it's probably not going to make sense for you. So, don't try to cheat the system here. This is for people that, tips are accustomed, and simply put, what they put into place was a deduction up to $25,000 of the reported cash tips from your federal tax income. Next, we have overtime pay. The change that they made was permits a deduction of up to $12,500 if you're single or $25,000 if you're married of overtime pay. Again, great things. Now, both of these, tips and overtime pay, the deduction is going to start to phase out once you earn over $150,000 for single filers or $300,000 for joint filers. So just keep that phase out in mind. The next thing I want to talk about that was a big change in the one big beautiful bill was the charitable deduction. There is now going to be a deduction for those that don't itemize. There's now going to be a charitable deduction for non-itemizers up to $1,000 if you're single or $2,000 if you're married. So this is a cool thing that even if you're not itemizing, you can still get a charitable deduction for any money that you're giving to charity. The other piece here that's important to talk about is this bill created a 0.5% floor on itemized deductions for charitable contributions. Basically, this means that taxpayers can only deduct charitable contributions that exceed 0.5% of their adjusted gross income. So a little bit of a floor there that you have to be thinking about. Now let's talk about auto loan interest deduction. This was, again, something that Trump campaigned about, and I think that a lot of people believe it was a move to get people, especially in some swing states that are high in auto, to move to him. But this is going to be for tax years 2025 through 2028, so 4 years. And this change permits individuals to deduct up to $10,000 per year in auto loan interest for vehicles that were assembled in the U.S. Again, this is going to phase out once you earn $100,000 if you're an individual or single, or $200,000 if you're married. The next item I want to talk about is the Trump accounts. So this is starting in tax year 2025. Basically, this establishes tax-deferred savings accounts known as Trump accounts, allowing parents to contribute $1,000 upon the birth of a child and up to $5,000 annually. Funds can be used for higher education, job training, or a home down payment. So we're going to learn more about kind of what these really look like, but this is part of that change. So again, let's kind of walk through some of the high-level personal related items. We have the permanent extension of the Tax Cuts and Jobs Act, that individual tax rates and brackets permanently extended. This is great news. The standard deductions from the TCJA was made permanent, and there will also increase for inflation. That's also good news. There's a child tax credit increase up to $2,200 now. There's senior tax relief. This is good for 4 years. A temporary $6,000 bonus deduction, and there's phase outs there. The SALT tax, the state and local income tax deduction, that has went up from $10,000 up to $40,000 cap. cap. This is good news, especially for those in high income states. There is some provisions on no tax on tips and overtime pay. Again, some phase outs to be considerate about, and then some changes to charitable deductions, as well as the addition of the auto loan interest deduction for the next 4 years, and then this idea of Trump accounts, which we'll learn more about as this bill starts to unfold. So those are some of the major changes on the personal side. Again, follow us for more. We're going to continue to dig deep and pull these apart and really get into the nuts and bolts, but wanted to do an over-level view so you had a high-level view of what the changes were in the one big beautiful bill. So now let's dig into the business-related changes, but real quick. If you're looking for tax strategies that you can actually implement, I built a software called TaxZone. We don't just show you how to save on taxes, we help you turn those strategies into real dollars saved with clear step-by-step guidance and full implementation. So if you're serious about paying the least amount of taxes legally possible this year, click the link in the description and book a free discovery call with our team. All right, now back to the business updates from the big, beautiful bill. So this is the business side. Obviously, if you're a business owner, these are gonna be really key things to dig into. The first one I would talk about is the qualified business income deduction, the QBI deduction. Again, this was part of the Tax Cuts and Jobs Act from Trump's original presidency, the big tax bill that came through in that piece. So the QBI deduction under Section 199A is made permanent at the existing 20% rate. So that's good news for business owners. Again, this is where you can deduct up to 20% of your income. So if you're making $100,000 a year, you immediately get a $20,000 deduction and you're only paying taxes on $80,000 from your pass-through entity. So this is big news. Now, the House had initially proposed increasing this deduction to 23%, but the Senate did not adopt that change. And so what it finally landed on was just extending and making permanent the 20%, which has been in place for the last few years. So that's good news there. The C Corp rate remains unchanged at 21%. There was talk about whether this would go down or up or change or adjust. That remains the same, so no big changes there. The biggest change, and one that has been people have been following so closely and is super powerful, not only business owners, but real estate investors, is 100% bonus depreciation. Big news, 100% bonus depreciation returns permanently. This restores full expensing for qualified assets, allowing businesses to deduct 100% of the cost of equipment, software, certain capital improvements that you have in the year that it's placed in service. So if you remember, a lot of times when you buy an asset, you go buy a vehicle, you go buy a new piece of equipment. Let's say you buy a piece of equipment for $100,000. Without bonus depreciation, you don't get $100,000 in the year that you purchase that vehicle. You spread it out over multiple years in the form of depreciation. With bonus depreciation, it allows you to deduct 100% of the cost upfront in the year that you placed it in service. So this is big news. A lot of people have been following it. Now, this is made effective for assets placed in service after January 19th, 2025. Again, this is a piece that if you're in real estate, if you're building buildings, if you have buildings for your business, this enhances the use and the want and need to use cost segregation studies, where we can break out parts of buildings and bonus depreciate parts of that in year one, which can provide massive losses that can be used to offset other income of ours. A great planning tool for businesses and especially real estate investors. The other piece I want to talk about on the business side is Section 179 expensing. Starting in 2025, it's going to increase the maximum deduction to $2.5 million with a phase out beginning once total qualifying property placed in service exceeds $4 million. So Section 179 is kind of the sister child to bonus depreciation. That limit for Section 179 bumped up to $2.5 million. Another item that has been put into place on the business side is the research and development expensing. So it suspends the requirement to capitalize and amortize research and development expenditures, allowing immediate expensing during this period. This was kind of an unintended consequence of the Tax Cuts and Jobs Act that was constantly put into bills ever since the TCJA passed. They were constantly putting this into bills to change it, to clarify it, but it was never done. Now it has been done, and essentially it makes the R&D credit extremely valuable again, especially for those that qualify. Next thing I want to talk about is the QSBS. The act replaces the 5-year holding period requirement for the exclusion of gain on the sale of qualified small business stock with a tiered exclusion based on the holding period. So QSBS, this is where if you're looking to sell stock, you have stock in a public company, there's potential where you can avoid gain on it. This has been a big play, especially for those software, those in software businesses that are selling, potential to avoid gain on really big payouts on those types of entities. This just got put on steroids a little bit. So a lot more flexibility here. We'll kind of deep dive into this one as well, but just know there's been changes to this and overall good changes to that. Finally, I want to talk about opportunity zones. These are tax advantage investments for when you exit a business or have a potential gain that you want to defer. The opportunity zone benefit was made permanent with modifications and special rules for rural areas. So this is a good thing. Opportunity zones was something that came into play with the TCJA, and it's been made permanent and will continue to do. Again, this is a way that you can sometimes avoid defer gains on sales or exits that you might have had, but also be able to invest in areas that need investment, that need new areas. So that's a cool thing. Other things that have been done, the estate tax. The estate tax has been permanently increased to 15 million if you're single and 30 million for married couples beginning in 2026. So people were scared about this falling off as well as ones that was set to expire. That's not going to happen. So the sunset scare is over. It's gone. It's not going to happen. The state and lifetime gift tax exemption has now been permanently bumped to 15 million for single and 30 million for married individuals. Now there's clear energy credits. Now this was kind of one of the big hits for it. Energy credits were something that were put into place with the Inflation Reduction Act, the IRA, a few years ago, where there was energy tax credits that were put into place. A lot of these are getting pulled back. And there's different details of when they get pulled back, when you have to put things in service. So if you're thinking about investing in this energy piece, you might want to start talking to some of your vendors, some of the people that you're working with, because there might be some changes, at least upcoming, or maybe already that you want to consider. Maybe you're pushing up a project or something like, or considering a different type of project based on just solely the tax credit. So again, let's do a high-level overview of the business side. Qualified business income. The Section 199A deduction made permanent at the existing 20% tax rate. Again, this was set to fall off after 2025, made permanent. That's a good thing. The C Corp rate remained the same, 21%. 100% bonus depreciation returns and is made permanent. This is great news for business owners. This is great news for real estate investors. Everyone loved this, and this was a big piece that we wanted to make sure was placed in the bill. Section 179 expensing. That's the maximum deduction per year is going to increase to 2.5 million. There's going to be some phase out around 4 million, but this is also good news. And then the R&D clause, where there was some R&D items where you had to amortize R&D expenditures, that has been changed. That has been fixed because it was an unintended consequence from the original passing of the original bill, the TCJA bill. That has been now fixed. R&D credits back alive again. They were always there, but now again they're more beneficial as well. And then there's been some changes to the QSBS deductions, opportunity zones, benefits made permanent with some modifications to it. This is all good news. Estate tax, 15 million for single, 30 million for married couples. Now the big loser, some things that are lost specifically on the tax side, is some of those energy credits. Energy tax credits are being taken away. Now, moving forward, this is an extremely large bill, and I'm going to continue to break this down and provide more context for the specifics. And all the items I'm talking about today, I'm going to break apart and talk about them specifically and some of the more specific deals and details of each of those different pieces of the bill. But I wanted to do an overview. Here are some of the quick hitting major items you want to think about. Follow me, like, subscribe, do whatever it is to keep you updated, as theirs are important not just for your business, but also for your personal life. So there you have it. This was an intro to the key tax aspects of the big, beautiful bill. If this episode helped clarify some of the chaos, hit that like button. Subscribe for continued no fluff tax strategy as we continue to expand on the different aspects of this new bill. Share this with someone who needs to know these new upcoming changes. Remember, big tax changes don't just affect billionaires. They impact every dollar you keep or lose. So stay sharp, stay legal, and as always, keep more of what's yours. And if you want help from our team of tax pros implementing this, along with many other tax strategies, visit www.taxelm, that's TAXELM.com, or click the link in the description for a free discovery call. We're helping people like you legally lower your tax bill every single day. Thanks for listening, and I'll see you on the next one.